Welcome to Tax Tips in 10 Minutes or Less. I'm Dean Barber along with Corey Holstein, CPA. Corey, thanks for being here.
Yeah, thanks for having me, Dean.
All right, so we're going to talk about a couple of different things here. We're going to talk about tax brackets. We're going to talk about how those tax brackets work, tax bracket management, maximizing brackets, and then we're also going to talk about a little history of the tax code and why this bracket management is so crucial. So let's start with a history of the U.S. tax code. So what year were federal income taxes first put into effect?
Got 1913 here, Dean.
1913. And I said before the show, I want to take a step back in time and I want to pay all my taxes at the top tax bracket between 1913 and 1915 because it was 7%.
Yeah, that's kind of a wild stat considering where we're at today here, Dean.
I mean, heck, the Social Security and Medicare tax is that today, almost.
Yeah, it between Social Security and Medicare, you're at 7.65%.
Yeah.
The employer also has to match that piece as well. So for our self-employed individuals, you're talking about 15.3% just for FICA.
Just for your just for your Social Security and Medicare. Now, in 1916, tax rates more than doubled up to 15%.
Yeah, and it's going to get worse from there, Dean, but I can't imagine the uproars that happened during that time period.
Yeah, so it's crazy. By 1917, just 5 years after the federal income tax went into effect, the top tax bracket went to 67%, and the next year to 77%, and by 1919, it was back down to 73%. And then during the Roaring '20s, something really interesting happened. By 1925, you get to a 25% tax bracket, and that lasts all the way to 1931. Okay, so here's what happened there, Corey. A lot of revenue, a lot of people are making a lot of money. The government realized we don't need to confiscate 77% of your income at the top level. We can do 25% and we can still have enough money to run the government.
And that was very generous of me.
Yeah. So then things happened. We had the Great Depression. And so by 1932, that top tax rate went back up to 63%, and it stayed there until 1936, Corey. Talk about what happened in the 30s and the early 40s. This is where it really got ugly.
Dean, I don't know. I don't have that answer for you. What are you trying to tip
Well, I
me
mean,
off
hey,
for?
we go to 79% tops tax bracket in 1936. By 1941, it's 81%. By 1942, it's 88%. By 1944, you have a 94% top tax bracket, and that lasted for 2 years, 1944 and 1945. 94% top tax bracket. Can you imagine?
I cannot, and thinking historically here, Dean, this is right when we're getting into the world wars, right? That time period, a 90 to 94% tax bracket is unheard of.
Hey, we appreciate all your hard work. We're going to let you keep 6% of what you make.
Absolutely. And remember, this is always the top tax bracket, so this we don't have the income ranges through this time period as well, but not really incentivizing me to work beyond that top tax bracket.
And the interesting thing is that the top tax bracket did not go below 70% until 1982. So from 1944, all the way to 1981, we had tax brackets between 70 and 94%.
And where are we at here today, Dean?
37 is our top tax bracket today, and that was just permanently extended, right? Like all these tax rates have been permanent, right? So we're permanently extended for the Tax Cuts and Jobs Act at 37% is our top tax bracket. We did get into some lower brackets back in the 1980s. Tax Reform Act of 1987 got us down to a top tax bracket of 28%. So that's really, in modern history, the most, the lowest top tax bracket that we've seen.
Yeah, and what's interesting to me, Dean, as I look through this chart and over this 100-year period here, it's interesting if you were to map the fiscal debt over the same time period. Now, a lot of spending has gone on in the last 20, 30 years here, but staggering results here of as our tax rates have gone down, this fiscal debt has also climbed dramatically.
Right.
And this is where we talk about where do tax rates go in the future? We know we got this permanent extension, but Dean, I have no idea what the word permanent means to Washington, D.C.
No. And I will tell you this. when we had the Tax Reform Act of 1987, as I was actually Tax Reform Act of 1986, I'm sorry. So in 1986, the top tax bracket was 50%. By 1988, it was 28%. So we almost cut that top tax bracket in half. However, there were people making the same amount of money in 1988 as they did in 1986. And even though the top bracket went from 50 down to 28, those people in the 28% bracket actually paid more in taxes. Why? Because they did away with a lot of the deductions and the credits. And there was a lot of things, I would call them kind of shenanigans going on there in the late 70s and early 80s, where you're getting actual tax credits for building real estate and doing those types of things. And it got kind of out of control, and it actually blew up the commercial real estate market there by the mid to late 80s.
Yeah. And we see tax rates from there, Dean, 28, again, being the lowest rate we see for a period of time. Into the 90s, we're up into the 31 type percent rates until we get to 1993. We see 39.6. That extends all the way into the 2000s here. And this is where we get into more of our current history. 35, right. 39.6 again during the 13 to 16, 17 range. And then finally, we get to the Tax Cuts and Jobs Act of 2018. There we see 37% taxation, which is, again, to your point, where we live today, where we are quasi-permanent
right
into the future.
And
here.
So let's talk a little bit about that. And so this will allow us to jump right into the bracket management, Corey, because let's go through the brackets here. So I'm going to just do married filing jointly. 0 to 23,850 is taxed at, and this is taxable income, okay, is taxed at 10%. 23.8 to 96.9 is taxed at 12. 22 runs from 96.9 to 206. 24 runs from 206 to 394. So we don't hit a 32% bracket until we're at 394 to 501, and then from 501 to 751 we're at 35. And so it's not until we're over 750,000 of income that we go into that 37% bracket. When you look at people's situation, Corey, and especially we want to talk specifically about people who are trying to position themselves to start having their money go to work for them and get that money out and spend it, this is where bracket management really comes in. So talk about what that means.
So what we're referring to there, Dean, with bracket management is utilize not only your current bracket, but think about what that next bracket is. Think about your marginal rates as you take more income moving forward. So to your point, Dean, about 400,000 of income, taxable income today, is still at a 24% tax bracket. If we think about what was set to happen next year before the One Big Beautiful Bill Act, we don't know the exact numbers, but that 24% bracket was going to turn to 28%. And instead of 400,000 of income, we were looking at somewhere around 275,000 of income to be at the top of that 24/28% bracket. We've gotten a gift here in recent years, Dean, where we can take a lot of income at reasonable tax rates. And when we talk about bracket management, it's really thinking about where are we at today, where are we at in the future, how do we maximize these current brackets in the current tax landscape?
So let's just give an example, Corey. Let's say that we have somebody who is retired, and let's say that their taxable income is falling in the 150 range. Mm-hmm. Okay, so the 22% bracket goes all the way to 206. So in that particular instance, you might say, you know what, we can get another $56,000 out of a retirement account at a 22% rate. Should we consider doing that and shifting that money over to a Roth IRA where it's be tax-free forevermore? In other words, can we pay a low tax rate today, get it tax-free forevermore? Is that kind of what you're talking about?
That's exactly what I'm talking about, Dean. And make sure you're working with the CFP, CPA, because if we are retired, we might be subject to Medicare, right? So those different factors as well. But that's really what we're looking to do is say, is 22% a good rate for this person long term? If so, use the full bracket.
And there's a lot of reasons why you'd want to do it. Just as one example, we call it bracket bracket creep, or however you want to call it. If one spouse passes away, the top of that 22% bracket drops down to 103,000. So that surviving spouse would be paying 24% on anything between 103 and 197. So there's a really good chance that money's going to have to come out at a higher rate later on. Needless to say, this is fun to talk about the history of the tax rates. It's really crucial to work with a CFP that's working with a good CPA. We have a whole team of CFPs here and CPAs here at Modern Wealth that are working collaboratively on your behalf to make sure that you're paying as little tax as possible over a lifetime. Corey, thanks for taking time to spend with me here on America's Wealth Management Show.
Yeah, thanks for having me, Dean.
I'm Dean Barber. Until next time, everybody stay healthy and stay safe.
The views expressed represent the opinion of Modern Wealth Management, LLC, an SEC-registered investment advisor. Information provided is for illustrative purposes only and does not constitute investment tax or legal advice. Modern Wealth Management does not accept any liability for the use of the information discussed. Consult with a qualified financial, legal, or tax professional prior to taking any action.